Hey guys, RC Peck here with Fearless Wealth. I want to talk about bonds. And regardless of your age, bonds give us some good insight into what's going on. After all, there really are only, it depends on how you measure it, but there are only four asset classes on the planet. We have companies, often called equities, right? But think about it, companies are private and public. Let's talk about the public ones, and we can just call those stocks. Then you have this whole category called fixed income, which basically is cash and bonds. We're going to talk about the bonds part in a moment. Then you have commodities, and then you have real estate. That's it, four places to put your money on the planet. So I want to talk about fixed income, and specifically, I want to talk about bonds. And on the screen is the US Bond Market Index. It's actually a Vanguard Total Bond Market ETF. And whether you look at BND or AGG, this is the S&P 500 of US bonds. And if your brain can look over, this is a 3.5 year time range on this price. And you can see this extreme volatility here. What's interesting is what you're not seeing is the intraday move. This is just the close of the day during this very short time period. And actually, I think it probably makes more sense if I zoom in. So I'm just going to go, instead of 3.5 years, I'm just going to go maybe 1.5 years just so we can see the last 2 weeks better. The peak up here is March 6th, way up here. And again, you can't see the intraday moves. They're even bigger. But without even measuring it, you can tell visually that something is going on with bonds. That's BND. Now, it gets a little worse. And when you follow the breadcrumbs, you find out that something, and perhaps the real problems with corporate bonds. Now, people have been taught that you diversify in bonds. You get some corporate and some inflation protected treasuries and some municipals, and you get some treasuries and some agency and some mortgage backed. But just like being over diversified in stocks, people can be over diversified in bonds. And something is going on with corporate bonds. This has not rebounded like the total bond market index in the US. And it's very likely that lines of credit right now are getting pulled on companies, right? And the majority of companies in this country have lines of credit to take care of short-term cash flow issues. And as we speak, I guarantee you there are thousands, hundreds or thousands or tens of thousands of companies that are getting letters and emails from their bank saying their line of credit has just been pulled. So they will not be able to get more. Now, well, if they have 5 lines of credit, do all 5 get pulled? Probably not, but maybe 3 or 4 of them would get pulled. And so I think that's what we're seeing here is in corporate bonds, something's going on with corporations and their ability to borrow money. And then also municipal bonds are looking just as bad. Now, if you blinked and you didn't see when I changed the ticker symbol, it looks exactly this. This is iShares National Municipal Bond ETF. So this is the Muni Bond ETF for the U.S. Again, like the S&P 500 of Muni bonds right here. And you can also see something is really wrong with the municipal bond sector right now. So you have the corporate bond sector in some pretty big pain right now, and you have the municipal bond sector in some pretty big pain right now. And then the last one of the bonds that I'm noticing is having some pretty big problems right now. And I'm not going to go into high yield because high yield, they actually move more like stock than not. And so most people would expect high yield to be cratering right now. But this is inflation protected treasuries. This just broke down to a low that hasn't been at since June of last year. I'm just curious to measure what this fall has been. So it's a 7.5, 7.6% fall. Now you have to remember there's kind of two promises of bonds. When someone hears the word bond, two things hit their brain, and their brain gets signaled with two things. One is they know they're going to get a yield, right? They're going to get paid because they're giving their money to some other entity, and that other entity is going to pay them. Okay, and the other thing is that there's the kind of promise with bonds is they are low volatility. Well, with corporate bonds, inflation protected bonds, and municipal bonds, the low volatility is gone right now. And that's a problem because most people, they were never taught that you can have extreme price volatility in bonds. They were just sold this idea that bonds are safe. Now, that's not all bonds. Um, IEF, which is the 7 to 10 year treasury, 7 to 10 year treasury right here, doing fine. So is the 20-year treasury. So the place, or kind of the part of the world that, the part of the bond sector that is still holding up better than not is US treasuries. But again, because people have been taught to be over diversified, they're taking on unnecessary risk. One last thing I want to show you is the international bond market, and that's being measured through BNDX. This is the Vanguard Total International Bond ETF. And you can see that it's not doing that well, right? So out of all the bonds, and again, there's lots of bonds in the international bond ETF, different countries, but all in all, money is still coming into the US to the bond market over the other bond markets throughout the world. I also wanted to show, because bonds, a lot of times people don't get this, but the price of bonds and the yield of bonds are inverted. So as the price goes higher, the yield goes lower. What you're looking at here is a price chart of the German 10-year yield. This is a 10-year time range. And you can see that for the last decade and counting, the direction is pretty clear. The red line is the zero interest rate number. So you can see since, let's see, June of last year, 10-year, the yield on the German 10-year has been negative. And that's a pretty big move higher. Again, when that yield goes up, the price goes down. What I find interesting is the yield in Japan is gone positive again, but it was negative for about, I mean, there was a little blip here. And so what's fascinating is just the extreme volatility. Japan is actually looking safer. When the yield goes up, this is a chart of yield, the price goes down. So it's interesting. People are actually moving out of Japanese bonds, and the US is getting some of that money. So when people go into pure panic, historically they end up just panicking into cash, because all things being equal, when you sell, you go to your local currency. And so what's interesting to watch is even some of the most stable bonds on the planet, the German 10-year and the Japanese 10-year, those prices are going down. Those prices are going down, and the US is going up. The US bonds are going up. Again, just the US Treasury. So lots of volatility going on right now. And, I guess the takeaway before I hit the pause button is, this is not the time to bottom feed. This is not the time to do a hero trade. This is really the time to, it's really time to simplify up, to really simplify up. Simplify up doesn't even sound, it seems like I should say simplify down, but to simplify up, right? To simplify your approach to make sure you get the big picture right. When I have more updates, guys, I will share them with you, and I'll just post them right to my YouTube channel. That's the fastest way I can do it and the easiest. And if you like this, please go ahead and just subscribe to the channel, and I'll be doing my updates here. If you have questions, the easiest and fastest way for me to answer your questions in regards to if there's something you want me to talk about, and I will if I think it's a great point or I can help the group, the tribe, just go ahead and send it to questions@Fearless Wealth. All right, guys, thank you. Again, this is RC Peck, and this is Fearless Wealth, and this is just another step in helping you protect your portfolio and your future.